Thursday, December 26, 2019, Maneco 64, home of alternative economics and contrarian views. Billy had a very nice Christmas. He even had some roast turkey yesterday instead of boring old dog food. Today I want to talk about hyperinflation, the reset, and why one needs to value assets in terms of gold. And I'll show you why by referencing this book, When Money Dies, by Adam Ferguson. It's about what happened in Germany during the hyperinflation in the early 1920s. We'll also be looking at the markets, of course. The markets are very thin. They're not going to be open regular hours in the next few days towards the end of the year. So it's always a strange time. Let's look at the markets first then, and then go into why it's so important not to neglect looking at things in terms of gold. And why is that? Someone might ask, some of you who have not been aware of gold and the monetary system for that long. In my opinion, it's because gold has been the most stable store of value for at least 3,000 years. Paper money stores value not very well. All paper money eventually goes to zero. Paper money, of course, is a good currency, but it's a horrible store of value. Not saying that gold isn't a good currency. The reason why it's not used as currency anymore is that paper money has been made legal tender. You can only use that to pay your taxes with. So let's have a look at the markets this morning. It's 7:15 a.m. London. Gold is continuing to move higher. It looks like that falling wedge formation is being confirmed. We're at 1503.65. This is spot gold, not futures. So we're up just over $4. The high's been 1505.81 and the low 1497. Silver's continuing to do really well, outperforming gold, which is a good sign. We're up over 1%. We've been above $18. Right now we're at 1795. The Dow future is up 36 at 28,545, or up 1/8%. S&P 500 is up 5 at 3227. NASDAQ 100 future is up 12 at 87.12. British pound this morning, my system says that it's up 1/3%, or just under 1/3, at 129.92. The euro is virtually unchanged, 110.90, so very quiet. The dollar's up slightly against the Japanese yen, 109.55, up about 0.2%. And actually, dollars just below 7 against the yuan at 699.66. WTI crude is down 1/4% at 61.18, and Brent crude is unchanged at 66.35. Let's have a look at the bond market. 10-year yield is at just below 191. So pretty much unchanged. So still contained, still below 2%. So there's a lot of talk for the last few years about the reset, also hyperinflation, and I've spoken about it. I've said in the past that the reset has been happening over the years. It's not going to be a one-off deal. Yes, it might accelerate at certain junctures. And I want to show you a chart here of the Dow gold ratio going back 200 years, courtesy at goldchartsrus.com. And as you can see, when this ratio gets to the top, when it makes tops stocks high, gold low. There's the top in 1929 when stocks were overvalued relative to gold. Of course, back then, gold was money. The dollar was as good as gold. You could ask for to redeem $20 into almost an ounce of gold. You could pay with gold. So everything was denominated in gold. And then we had the crash, and that ratio, of course, dropped. And that was the reset back to around 2. And then over the next decades, the system inflated again. We were still under a kind of a gold standard. It was different. It was the Bretton Woods. It wasn't completely a 100% gold standard, because domestically, you didn't have to redeem your dollars or your paper money, or you couldn't redeem it for gold. You couldn't hold gold. But internationally, the US was obliged to redeem Federal Reserve notes for gold to other international treasuries at $35 an ounce. Anyway, we topped again around 26 this time. I think it was in 1966. And then we had a reset that basically took about 14 years until the early 80s. And we went almost down to 1. That's when the Dow was around 800 and gold was around 800 in 1980. And then up until 2000, we saw the system being inflated again. This ratio got up to around 45, 46. That was in 1999, 2000, at the top of the dot-com bubble. So what I'm trying to say here, we are seeing a reset since 2000. It might sound weird to say that we're seeing a reset, even though the Dow now is at 28,000, but the Dow was at 11,700 at the top in 2001. Someone might say, what are you talking about? We've had a bull market in the Dow. Well, I would argue that we haven't had a bull market in the Dow in real value. And what's real value? Gold. Paper money, as I said, is not a very good measure of stable value through time. Yes, it's a good currency. Yes, it's a good form of payment, but it certainly hasn't been a good store of value. So if you look at gold in the year 2000, we were around $250. Now we're at $1,500. That's up 6 times. We look at the Dow. At the top in 2000 was 11,700. So I'll do the math here. So the Dow is up 2.4 times. So you tell me which asset has done better. Well, I wouldn't even call, I guess you can call gold a monetary asset. You can see that we have been having a reset. Of course, that reset was quite accelerated at one point in 2011, 2012. But the powers that be decided to throw everything at the system to slow down this process. How do they do that? Well, the Fed kept going with their QE. We saw the ECB throwing everything at it to try to save their system with the crisis, the sovereign debt crisis. But it's only a correction. We need to see that ratio, the Dow Gold ratio, go back down to 1 or even lower. I would venture to say if we go a lot lower than 1 or 0, if it really accelerates, that is the hyperinflation. That will mean that everything will lose a lot of relative value in terms of gold. And I think a lot of people will not even realize we're having a hyperinflation because in terms of paper money, things might get worse. They probably will get worse. There will be a cost of living will rise for the general public, like it's already been rising. but it won't be as visual as back in the 1920s in Germany. With that, I'm going to look at a passage in the book on page 118, When Money Dies. And it reads, "The report of the Deutsche Bank for 1921 showed clearly how greatly inflation had reduced the gold value of dividends, in contrast to the illusion of prosperity which higher paper dividends caused. The bank's paper turnover of 2,125 milliards, I think that's billions, milliards, in 1921 had a real value of 85 milliard gold marks. In 1913, when the bank's ramifications were less extensive, the turnover had been 129 milliards. The 1922 dividend on a capital of 500 million was equivalent to 1.5 million gold marks against 25 million dividend distributed in 1913 at 12.5% on capital of 200 million. So you can see here, and I highly recommend this book. I can't go through all the details, but they're always comparing the purchasing power of a lot of the goods in Germany at the time in this book. They're comparing it, of course, to the Reichsmark. That was really inflating away, but also to sterling and the dollar. And don't forget, in 1922, 1923, the dollar and sterling were very stable. The dollar, of course, was as good as gold. So I think it's a big mistake to just look at the value of assets nowadays in Federal Reserve notes, in pounds or euros. We really need to keep an eye on the gold value of things. So as you can see here by this long-term chart of the Dow Gold ratio, I think we've reached a top. This correction since 2011 is finished in terms of the Dow Gold ratio. Now I'll show you a shorter term chart here. You can see that we've been building a head and shoulder top. This is a 5-year chart. Yes, the next key level will be down around 16. That's the neckline of that head and shoulder, but it definitely looks like it's a top. I actually think the reset might accelerate a little bit. It's difficult to say when we're gonna really complete the reset. It will definitely be when the Dow Gold ratio are near 1. I don't know at what level that will be. If it will be 5,000 or 1,000 or 25,000 or 50,000, difficult to say. My conclusion then is that it's very important not to fall into the trap of measuring things in nominal values. You need to look at things in real values. The mainstream media, mainstream economists are not going to tell you that you need to look at things in terms of gold, because they don't believe in gold. They're mostly Keynesians. They don't think gold is useful, but I believe gold is still the most stable store of value. It has been for over 3,000 years, and it will continue to be so for the next few thousand years, in my opinion. And why are they not looking at this? Well, because they've been educated or brainwashed into not considering gold as an important monetary asset. When I went to university, there was very little talked about or taught about gold. The only thing my professors ever mentioned was that Nixon closed the gold window, but they didn't really elaborate much on things. So that's why it's important not to put too much importance on Dow 30 or 40,000. You need to keep an eye on relative values, and that's gold. Silver to some extent, but gold really is the ultimate store of stable value, and that's what you need to keep an eye on. Highly recommend this book. I'm reading it again. I'm putting aside a few passages. I will make another video about what happened during this period, how mortgages were affected during the hyperinflation, and other things. If you enjoyed this video, please hit the like button, subscribe to the channel if you haven't yet. You can also follow me on Twitter, BitChute, Steemit, and on DTube. I wish you all a great day and a great rest of the holidays and New Year, and I'll talk to you later. Take care. Bye.